if it feels too good to be true, is usually that's the case in the markets. When I struggle, I go back to the very basics. And the very basics for me are, if I'm up 5%, sell half, move stops to even.
When should I sell to strength? When it feels too easy, when it feels like the stock can't gap down.
Performance is an eventual goal. It's not a stage-based goal.
So however you define the shift from this uptrend to downtrend and what makes sense for your style, that's how you should sell the last core of your position.
Your objective, which is part of your business plan, and how you describe of how you want to trade the markets, has to be very clear.
All right, so selling into strength, there's a lot of questions about this, and every webinar we've done, we'll provide some guidelines here for you. But especially if you're in stage 1 or stage 2, you want to sell at least some at your average gain, typically a third of your total position. That helps just lock in some profits and make sure that you're getting something out of the trade, and it'll pay for the loss if it returns back to break even. You can
especially stage 1 and 2. Right. Stage 1 and 2, you just make it a rule that the idea is to build experience over a series of trades so that you could be operating on intuition and feel, right? That's what stage 3 is really about. But so stage 1 and 2, just make it at my average gain, I'll sell a third, and then the 2/3 you can be creative and manage it the other way. So at least you're making some sort of progress rather than just you see a gain and then you wipe it away. You see a gain and you wipe it away. That's what a downtrending equity curve really is, right? So at stage 2, there's some sort of edge you have. Just sell a third. It's not the end of the world, right? You'll make some sort of progress. So,
yep. And another rule of thumb is look for extensions from those moving averages, especially if the stock has already had a pretty significant move. Here's some guidelines. This is going to be very stock dependent. Some stocks allow, will move 50% above the 21 EMA, and that's normal. Some will only move 5%. It's very dependent on the character of the stock. But here's some guidelines, 10% from the 10-day simple, 20% from the 21 EMA, 50% from the 50 SMA, 100% a double from the 200 SMA. These are pretty good starting points that then you can mold and apply to different stocks that you're looking at. But for instance, this example with, I think this is CVNA over here on the right-hand side. This is a very wild stock with a high ADR. And I think these extensions from the 21 EMA are about 60% or something like that. But that's within the character of the stock. So if you learn to recognize, what is this distance from the key moving averages that's acceptable, when it gets above that level, you can see it needs some consolidation, needs some basing. It happens again here. It happens again here. So you can do this visually. You can do this mathematically with a percentage or an ATR distance, but you should also be able to just recognize it visually and get a sense of what's extended for that particular stock that you're focused on. So look at prior extensions, eyeball it, calculate it from the MA, ATR from the MA, and also another good frame of mind to, when should I sell to strength? When it feels too easy, when it feels like the stock can't gap down. That's often, right before a basing period begins or a correction or something like that. So never be scared to lock in some profits, especially a third to a half of your core position. Ryan, anything about selling into strength that you want to add here?
Sometimes I think it's just good to sell into strength if you're up, just to feel good. You don't need a rule for that per se, especially as if stage 2 traders, if you feel like you're getting very happy and over the moon and the market's just rewarding you. I know traders, in stage 3, like Ross and I, like if we feel this is too good to be true, we just sell a little bit and we just say we need to make sure that we get something out of this, because if it feels too good to be true, is usually that's the case in the markets, right? That was a lot of 2020. It felt too good to be true, where traders that usually have 5 to 6 positions average 6 to 12 positions because there was so much working in the markets, right? So when you're in that situation, it's just a psychological step, right? If you want to turn that ship around, when you have a positive situation going, performance is a focus of stage 3. Performance is not a focus of stage 1, 2. You've not even figured out what you're doing in stage 1 and 2. And if you want, your sole focus is I want to perform. And if I sell a third, I'm giving away too much, and you're negotiating it mentally with the markets. It's a level of stupidity at the end of the day, because you're stage 2 and you're stage 1, right? So what you want to do is build good habits. You want to build good routines. You want to build good entry tactics. You want to build model books. You want to do all the hard work to get to stage 3, where you could feel like you could have an equal footing with the market. When you don't have an equal footing with the market, right, and you still want to perform, and you don't want to sell a third because you want to maximize your profit, you don't really even know what you're doing to even maximize profit. So take a third, take some off, try to turn the equity curve around. That's your sole focus, is to shift it from a downtrend to an uptrend. When you do that, then you're at an equal footing with the market. You can negotiate how you kind of dictate what your actions are going to be, because you've built that over a span of time. So selling a third, like I do it, when I struggle, I go back to the very basics. And the very basics for me are, if I'm up 5%, sell half, move stops to even. And I go back to that when I'm struggling. I literally don't do anything else. When you struggle, you go to your top entry tactic and setup. You look for that, right? Because you have a string of losses now. Your confidence is kind of, shattered. You go back to what can turn that around for you in terms of your confidence. You get that right. You do the basics, and then you go and get creative from there, right? So that's the same thing we said with position sizing, is when you can't have equal position sizing as you rack up losses, because things are not working, so you need to size down. Same thing with here. Sell into strength, get some profit, reduce your risk, so that you can continue to turn the ship around from stage 1 to 2 to 3. So
yeah. And one more thing I want to add here is, if you bought a stock right when it's, coming out of a range, you've fulfilled the entry tactic and it becomes extended, especially if on the left side there's a potential area of resistance, whether it's a moving average or, a clear level from prior. That's also, an added reason to take a little bit of profit, because, these reversals can happen. You might feel bad the next day it goes up another 5%, but then you'll feel a lot better when it drops 20% in basis. So, sell some into strength, especially when you're coming into a clear level of resistance, depending on the market as well. If it's choppier, you definitely want to do that, because it's more likely going to have some type of reversal at that level. So I think we can move on to how much. Ryan, you want to take this?
Yeah. So stage 1 and 2, it's about consistent, hard rules that you have to follow. You have to write them down, and you want to define, I'm going to take profits when I see the stock hit my average gain over the last 10, 15 trades. I'm going to take some off. So stage 1 traders, I recommend, I go back to stage 1 when I have a string of losses. So I sell half the position at 5%, move my stops up, and I act like the market's just, it's punched me into submission, and I'm back to stage 1, and I need to build my confidence back up. So I go back to this rule that literally that's what I'm doing, right? And stage 2, you could sell a third at 5%, then move your stop up and to negate that, right? So stage 1 and 2 is all about consistency. It's not about performance. If you're up as much as the S&P 500, and you call yourself, 2.5 stage 2 type of trader, that's amazing at the end of the day, right? Stage 3 is a whole different, ball game. You're working on you're working on feel, you're working on very market dependent or stock dependent. You could trade a CVNA differently than an Uber. That the tendencies of the stock and how they trade, and you could figure that out, relatively quickly just by looking left on the charts. And stage 3 kind of, these don't apply, but frequently stage 3 traders come back to stage 1 and 2 rules when they don't, when they string together a whole bunch of losses, right? So this never goes away. This loop of, how you feel and where your confidence level is usually, you're pretty confident at stage 3, but if you hit a string of losses, you kind of go back to your basics of what got you there in the first place. So Um, these are some of the frame. The most important point here is performance is an eventual goal. It's not a stage-based goal. It's only a goal at when you have the proper mechanics of what you've done over a span of 5, 6, 7, 8 years in the markets. Only then you can kind of move away from that. So selling into weakness, Richard.
Yeah, sure. So selling into weakness is the other side of the equation. This can be the remainder of your core that you started with. And you basically want to sell this core when the stock breaks the trend based on your definition of trend, whether that's higher highs, higher lows. It can be a moving average. That's kind of my preference. It can be based on Darvis boxes, the phases of the moon, whatever you want to use to sell the rest of your position. Go ahead and use that. You can use a break of a range near moving average, two closes below an MA like Rye does. But basically, you want to let the rest of your position work. You can maybe even add back the position that you sold at strength if there's another setup that comes around. And we want to reemphasize in strong uptrends, try to give the stock the benefit of the doubt. If it's just a little bit below the moving average that your rule is based upon, and it's a strong market, give it a chance until the end of the day to work itself out and potentially close above. But in choppier markets, be a little bit more strict and make sure you're preserving that capital. So yeah, this is kind of the not the easier side, but it's the more clear cut. The selling into strength, there's a lot of nuance there, a lot of feel, especially with stage 3 traders. This, you want to be a little bit more systematic with how you define trend and when does that trend end. Again, for your time frame, for your style. Position traders versus swing traders will define that a lot differently. So, Ryan, anything to add on your side here?
Yeah, no, just I think the importance of, for me, I use two closes below the MA if the market allows me to do that. So two closes below the 21, I usually get out. Or if the 21 and the 50 are closer together, then I use kind of both. Because let's say I'm up 30 to 35% on a position, I will give back that 5% just to see what it does, or that 7%, right? Gain out of the 35 just to see what it does. So it's really it's dependent on that situation. But it's important to not round trip completely, right? You have a 20, 25, 30% winner. You've done everything right. And then you don't end up rewarding yourself because you fall in love with MasterCard's the best company ever, and Home Depot's this and that, Boeing's amazing, and all of that stuff. So you don't want to get into that realm, because your objective, which is part of your business plan and how you describe of how you want to trade the markets, has to be very clear, right? If you want to be a Peter Lynch style and you hold things over a span of years, then that's a horizon you have set for yourself, and you're doing that consistently. That's good. That's awesome. It works for you. As position and swing traders, we can't do that. So we're in it for the momentum. When the momentum sucked out, we need some sell rules to say, okay, I'm up 35% and I'll give back. I'm okay with giving back 7 to 9% just to see, how this new consolidation plays out. And if that new consolidation continues to go down and now it's eating up, and get the 35% gain is now 25 is now 20, you're giving back way too much at that point. So
yeah, and sticking with this, I want to go through the example a little bit here, and let me know, anybody in the comments, if you know what stock this is. I don't know what I'll give you, but I'll give you like a digital high five or something like that. So so let me know your guesses in the comments. But here we see a stock trending above a rising 21 EMA, rising 50 SMA. We form a consolidation here. We try to break out, and then we form a higher low here. There's like a clear higher low that's put here. We can't quite hold this breakout level, and we break below the low of this range and the 21 EMA all in one bar. And that would be kind of my personal signal. If I'm not already out on this failed breakout or this reconfirmed failed breakout, I'd be selling the last of my position here if I hold it from lower. And from this point on, the character of the stock changes. Position traders might have held this until it gapped below the 50-day moving average. That's their style, that's their rules. But for me, the trend changed at this point. And from this point on, you can see it gets choppier. It finds resistance at those moving averages. We start forming lower highs and lower lows. The moving averages are now declining. The stock is trending below those moving averages. So however you define the shift from this uptrend to downtrend and what makes sense for your style, that's how you should sell the last core of your position. So I think that's a nice example to put it all together. And Rye is the only person who got it right. So there you go.
I didn't even cheat.
Yeah, he didn't even cheat. So this
I
is
remember the 600 on Zoom. That's
yep,
why. That's
yep,
all.
yep. So this is Zoom back in the 2020 top. And yeah, it was a clear trend change, but a stock that had been the leader, the face of the 2020 rally, and if you just listen to price and volume, you would have noticed that trend change.